Now, let's think about a related type of derivative called a forward. Forward contracts are similar to futures, except that they trade over the counter. They are common for currencies and interest rates. So you can sort of think about forwards as exclusively over-the-counter equivalents of futures. The forward price, though, is quite similar to the futures price. It's the delivery price that would make sense for the contract being negotiated right now. In other words, since both parties again have to agree to a specific forward price, the contract must be worth exactly zero to both of them. Since derivative contracts are zero-sum by definition, well, that means that at the origination of the contract, both parties must agree that they are essentially indifferent between whatever the forward price proposed in this contract is and, well, I guess not taking the forward contract. In other words, the price must be fair, but it is not to the advantage of either party, because both parties have to agree. And if it's not to the advantage of either party, that means that no money has to change hands when the contract is made. And of course, then with different maturities, the forward price may, and in fact should, be different. And this is true of the futures price as well, because if both parties agree that the fair price of, let's say, gold is $11.75 in April, they may have different expectations about what that equivalent price would be in, let's say, June. And so that would mean that the June price would be set separate from the April price, just based on the supply and demand of people who want to buy and sell June gold futures. And therefore, that price may actually be quite different. So let's go through an example of forward prices. Let's say that on the 13th of May in 2015, we go to either our counterparty or through some sort of centralized counterparty system, we see bids and asks from several potential counterparties for a forward contract on dollars per pound. In the spot market, in other words, what you could get for a pound right now in terms of dollars, as well as what you could expect to lock in for exchange rates between dollar and pound at the 1, 3, and 6 month time horizons. Now, these exchange rates are effectively the price of 1 pound in dollars, right? And as in most markets, you will see a difference between the bid price, in other words, what somebody would be willing to buy from you for, what you could sell for, and the offer or ask price, the price at which someone would be willing to sell to you, or what you would be willing to, or would you be able to buy at. So we can see, for example, in the spot market right now, we could buy a pound for $1.575. And if we had a pound to sell, well, we could get a little bit less dollars for that. We could get 1.5746. So it's a relatively tight bid-ask spread, about 0.0004 difference between the bid and the ask. But of course, the reason that this spread exists is sort of to subsidize whatever exchange or middleman is organizing this market, as well as potentially if there's a dealer to sort of guard them against any sort of informed trading, or to account for the liquidity or illiquidity in this market. Given how tight this bid-ask spread is, it seems, and of course, given what these assets are, the dollar and the pound, it wouldn't be surprising that this is a fairly liquid, in fact, a very liquid market with low chance of toxic order flow or sort of informed traders trying to take advantage of trades in the dollar relative to the pound. So the bid and the ask are close, but they're still kept apart by this idea that the middleman takes a cut of all transactions sort of to subsidize their own operations. So if you then look out at the 1 month time horizon, the 1 month forward prices are still the same. The bid and the ask price are different. The ask price or the offer price is higher than the bid price. So no matter how far you look out, indeed you can see that you will always be paying more dollars if you want to buy a pound than you would be receiving dollars if you wanted to sell a pound. And indeed you can see that the difference between the bid and the ask is slowly rising due to this idea that longer term contracts are probably more liquid, and there may be more room for potential informed trades in them, and they may be just harder to hedge on behalf of whoever the centralized counterparty is. So for all these reasons, the bid and the ask does go up as the maturity of the contract goes up. So this behavior that we're seeing here is not surprising. So now what would we actually do with this set of quoted bid-ask exchange rates for US dollar to pound? Well, let's say that we want to sell 100 million pounds 6 months from now. Well, remember, if we want to sell, we would sell at the bid, and if it's 6 months from now, this would be the price that we're using. So let's say that on this day, the treasurer of a company wants to sell 100 pounds into dollars, probably to offset the exchange risk from some transaction in dollars. And of course, since we are agreeing to sell, we're going to use that bid price for the 6 month forward. Now what this obligates us to do if we are in the place of this treasurer is to, in 6 months' time, pay 100 million pounds and receive 157.3 million US dollars per that forward exchange rate. 6 months from now, so if this was in May, that would be in December. What are the possible outcomes? Well, really it's just sort of a matter of, is the spot exchange rate above or below the forward rate that we have locked in? So let's say that the spot dollar to pound exchange rate, that is $1, I promise you, even if it may not look like it. The spot dollar to pound exchange rate, let's say that is 1.6 dollars per pound in December. Well, what would that mean for the value of our forward contract? Well, we've committed to sell 100 pounds for, or I guess 100 million pounds for $157.3 million. But, of course, if the spot exchange rate is $1.6 for every pound, that means that in the spot market we could have sold that 100 million pounds for 160 million US dollars. So the value of the futures contract to us at expiration is, well, what we actually will receive, the 157.3 million minus what we could have received, which is 160.0. So that is about $2.7, and if these are all in millions, 2.7 million at a loss, of course, because again we're giving up $160 worth of pounds as far as they're valued in the spot market, but we're only receiving 157.3 million US dollars for it. Now what if instead the other possible outcome, of course, is that the spot price is actually, the spot exchange rate is below the forward rate. So the alternative we could consider is, what if the spot price of a pound in dollars were 1.5? Remember, the price that we had locked in was 1.573. So if it were 1.5, we'd actually have locked in a favorable exchange rate. What would be the value of our forward contract then? Well, we will still receive the 157.3 million US dollars because we have committed to sell 100 million pounds for that much. But now, what are we giving up? Well, we're giving up 100 million pounds that is only worth, in the spot market, 150 million, because in this scenario, each pound is only worth $1.5. So in that case, we are making a profit of $7.3 million. And this is, of course, dollars in both cases. But why are we doing this? Remember, this is the point here is probably not, and if we are the treasurer of a non-financial corporation, almost definitely not, to speculate on exchange rates. The point is to avoid exchange rate risk in whatever we needed to, whatever other transaction we have planned that needs us to convert pounds into dollars. And by agreeing this forward sale of 100 million pounds, we've effectively done so. So we might incur a loss or a gain on the forward position itself, but what that will do is it'll ensure that the effective rate at which we actually do transfer the pounds into dollars will stay the same.